Christopher Harvey, Wells Fargo Securities head of equity strategy, is here at Post 9. It's great to have you back, Chris. Welcome.
Good to be here, Carl.
We're basically at your target now, right?
That's right.
You feel good sort of standing pat for the next 6 weeks?
Pretty good. We still think a couple things. You could go higher, but if you go higher, we don't want people to be greedy, take some profits, be a little bit more defensive. In the short term, we could see a sell the news around the Xi-Biden event because you have a lot of good news priced into that. You have people looking forward to that, and that announcement might disappoint. But that's really a short-term issue.
Why Uber caps? Because it has worked?
Well, it has worked. Balance sheets are great, better earnings. They have the AI kicker. And if you look at the economy is in an economic malaise. And if you're looking at value, looking at smaller caps, they just don't work in this kind of environment.
That's why the Russell was down almost every day last week, right? The spread between small and large is historic.
Yeah, so Russell has a really hard time. Russell was almost in a bear market. When rates go higher, the economy's not really working. Small caps, risks, they just have a difficult time getting out of their own way. In this kind of environment, it's really about growth. It's about high quality growth, and that's what's working, and that's what we think will continue to work. But one thing, if you look at a lot of defensive sectors, whether it's low vol, whether it's staples, whether it's utilities, they are now reaching oversold levels, and that's something we're thinking about a lot more closely.
One thing you talked about last week was that the rate rise last couple of years might have undone SVB, but you say it was not a clearing event.
That's right.
And that the 30-year auction implies that there's still some work to do or consequences to be had?
There's a lot of work to do. If you look at duration is in really weak hands, right? What we've done is we mispriced duration for a long period of time. SVB was an event, not a clearing event. A lot of those portfolios are still underwater. A lot of the duration players don't have the risk to put on. And if you can't do that, right, we could see rates back up pretty aggressively. Rates backed up, they just floated up, not for fundamental reasons, but because people couldn't put on that risk. And that hasn't gone away. And the last thing we may see before year end, we may see tax loss selling in bonds, something we haven't seen in years.
You said something earlier about the Xi-Biden meeting. You said that it might disappoint. And I'm curious what you think the market's expectation is there, because I thought it was pretty low expectations as far as what we expect to happen.
So if you look at the equity market and the equity market run, especially over the last couple of days, last couple of weeks, it's been pretty aggressive. And I think people look at what's happened. A lot of the tech, a lot of the bigger cap companies have rallied on that. They're going to come out with something positive, but I just don't think it's going to be positive enough. And are the expectations low? They might be low, but the market's not acting as if it's low. Mm-hmm. We had a heck of a run over the last couple of weeks.
Isn't that just about lower bond yields, though?
Yeah. The bond yields haven't moved that low. We're still at 460 something. So bond yields have come down.
It's not 5%. Feels better.
No doubt it feels better, but we're coming from sub 4,200. You can only account for a certain amount. One of the things that I think is also happening is we went through earnings season and we saw margins expand. We saw revenue go from contraction to growth. Something's happening on the fundamental side that we did not expect, and I think the market's appreciating that as well.
Something good's happening on the fundamental side. I mean, again, right, we had our first quarter-over-quarter year of EPS growth since third quarter of 22.
That's right. And here's a funny thing. The qualitative and the quantitative aren't matching. If you look at, you talk to C-suite all the time. What are they saying? They're saying, hey, the consumer's difficult, the economy's difficult, rates are higher, lions and tigers and bears don't know, but you look at the quantitative information, and it's much, much better. And it's broad-based. We thought that the margin expansion was only going to be a couple companies. It's broad-based. It's across sectors. It's across stocks. A lot of people are talking about productivity enhancements, and that's a sticky. That's something that stays around for a while.